Hello, finance enthusiasts, and welcome back to today's Finance News, your absolute go-to channel for everything moving the markets, breaking down wealth, and keeping your portfolio ahead of the curve. Today, we have three absolute blockbuster, jam-packed updates regarding United States finance that just hit the headlines a few hours ago. Trust me, if you are a true finance enthusiast who cares about where the big money is moving, you absolutely do not want to miss a single second of this video. But before we dive straight into the numbers, if you are new to the channel, make sure to hit that like button, smash the subscribe button, and turn on all notifications so you can permanently stay in the loop with the latest financial shifts. Let us kick things off with our very first major update of the day, which has sent shockwaves through the tech and space sectors alike. Update 1. The shocking fall of the first trillionaire. Elon Musk has officially lost his historic trillionaire status. Now, if you have been tracking global wealth, you know that Elon Musk has firmly held the crown as the wealthiest individual on the face of the planet since 2024. He famously crossed that legendary, eye-watering $1 trillion net worth mark for the first very time when Space Exploration Technologies Corporation, which trades under the ticker symbol SPCX on the National Association of Securities Dealers Automated Quotations, saw its shares briefly rocket past $200 each during its highly anticipated first week of public market trading. But the markets are a brutal arena. A massive 26% drop from those all-time highs has dragged the stock down significantly, officially stripping Elon Musk of his trillionaire title. This sudden wealth destruction raises a massive, urgent question for everyday market participants. Are Tesla and Space Exploration Technologies Corporation stocks still a compelling buy on this current dip? Or are we witnessing the popping of a massive hype bubble? To understand where the smart money is moving, we have to look directly at how Elon Musk's gargantuan fortune is structured. Unlike historical tycoons, modern billionaires have the vast majority of their net worth completely tied up in equity, usually heavily concentrated in the corporations they actively manage. Elon Musk currently sits at the helm of two of the top 15 most valuable enterprises in the entire United States, owning an incredibly dominant stake in both. As of this July, he controls exactly 717.1 million shares of Tesla, which translates to a 15.7% ownership stake in the electric vehicle pioneer. At today's current market valuations, that position alone is worth roughly $282.4 billion. Simultaneously, he maintains a massive 46% ownership stake in Space Exploration Technologies Corporation, with provisions to accumulate even more equity based on strict operational and financial performance milestones. At current private and public market valuations, his spacefaring equity accounts for an astonishing $704.5 billion. When you combine those two massive pillars, his total personal net worth rests at $987 billion, failing just shy of that mythical $1 trillion milestone. Despite this massive pullback, both enterprises remain firmly entrenched in the exclusive $1 trillion corporate club. Space Exploration Technologies Corporation stands strong as the seventh most valuable corporation in the United States, with a total market capitalization of $1.94 trillion, while Tesla occupies the 11th spot with a valuation of $1.48 trillion. However, the short-term trend lines have been incredibly painful for investors. Tesla stock has tumbled 12.4% throughout this year alone. Meanwhile, Space Exploration Technologies Corporation is hovering at roughly $148 per share, which is technically still above its initial public offering price of $135, but notably lower than its opening market price of $150. So, what does this absolute volatility mean for everyday retail shareholders? Tesla has undoubtedly been one of the greatest wealth-generating engines in corporate history, skyrocketing more than 24,640% since its initial public offering, creating countless self-made millionaires out of ordinary investors who had the courage to hold. However, just like Space Exploration Technologies Corporation, the stock has historically traded on immense speculative hype and an intense fandom surrounding Elon Musk's public persona. While it remains a fundamentally growing enterprise, the competitive landscape in the electric vehicle industry is accelerating at a breakneck pace. Investors are increasingly terrified of shrinking profit margins and an extraordinarily stretched valuation. To put this in perspective, based on its contracting net income, Tesla currently trades at a staggering 368 times trailing 12-month earnings. Space Exploration Technologies Corporation commands an even extreme valuation premium, trading at a mind-boggling 110 times sales, while simultaneously reporting deep net losses. It becomes glaringly obvious that the core investing thesis here relies almost entirely on absolute faith in Elon Musk's long-term multi-planetary vision. Furthermore, retail investors face a unique structural risk with the space company. Elon Musk commands an absolute 82.3% of the total voting rights. This means minority shareholders possess zero corporate recourse if they disagree with his leadership decisions or the strategic direction of the enterprise. As it stands today, neither of these high-flying giants looks like an absolute bargain on this current dip, making caution the ultimate priority for serious finance enthusiasts. Update 2. The $472 million industrial takeover. How Enerpac is expanding its global footprint. Moving right along into our second massive financial update of the day, we are shifting our focus to a monumental power move in the industrial sector that is completely redefining the manufacturing landscape. Milwaukee-based industrial tools and technology heavyweight Enerpac Tool Group has officially acquired SFE Group in a staggering cash and debt transaction valued at approximately $472 million. The major announcement came directly from Enerpac Tool Group corporate executives, who detailed that the acquisition perfectly aligns with the company's strict long-term strategic priorities and rigorous financial criteria. When breaking down this corporate transaction, the leadership teams from both organizations expressed immense enthusiasm for the future growth metrics this merger unlocks. Paul Sternlieb, the standing president and chief executive officer of Enerpac Tool Group, highlighted the sheer quality of the acquisition targets by stating that SFE Group is exactly the type of high-quality, rapidly growing business they have been actively seeking to absorb. He noted that SFE Group represents a premium brand platform characterized by remarkably strong profit margins, a highly complementary market position, and a deeply demonstrated track record of delivering both organic and inorganic industrial growth. More importantly for macro investors tracking this stock, Paul Sternlieb pointed out that this single transaction instantly expands Enerpac Tool Group's total addressable market by an estimated $1 billion. By integrating SFE Group into its broader operational umbrella, Enerpac is positioned to aggressively advance its pure-play industrial tools and solutions strategy. This acquisition allows them to scale their technical expertise, broaden application capabilities, and maximize existing customer and channel partner relationships across attractive new industrial tools categories. To truly understand the massive financial weight of this $472 million deal, we have to look closely at the operational layout of SFE Group itself. Currently headquartered in Houston, Texas, SFE Group operates as a major global provider of highly specialized fabrication, welding, portable machining, and heavy material handling equipment. The corporate leadership of SFE Group will remain highly stable post-acquisition, with current Chief Executive Officer Vinay Varma continuing to spearhead operations directly under the new title of President of SFE Group. Vinay Varma publicly noted that joining the Enerpac Tool Group ecosystem marks an incredibly exciting new chapter for their global team, providing the crucial financial resources, operational rigor, and corporate platform necessary to accelerate heavy investments in next-generation innovation. From a strict corporate finance perspective, Enerpac Tool Group is structuring the entire $472 million acquisition through a calculated blend of existing cash reserves and new debt financing, with the final transaction expected to officially close in the first quarter of fiscal year 2027. Enerpac Tool Group is already a massive industrial powerhouse, maintaining its global headquarters in Milwaukee and employing over 2,100 workers across the globe, with roughly 130 of those team members based directly within the greater Milwaukee metropolitan area. This major acquisition signals an aggressive consolidation of market share that finance enthusiasts should monitor closely as the integration unfolds. Update 3. The Sushi Tech Revolution: How Kura Sushi USA is fighting tariffs and winning the margin war. For our third and final financial update, we are diving deep into the restaurant and consumer discretionary sector, where a massive battle between macroeconomic pressures and technological innovation is unfolding. Kura Sushi USA, which trades under the ticker symbol KRUS on the National Association of Securities Dealers Automated Quotations, has officially released its fiscal third quarter earnings report. The data reveals a highly resilient business model that is successfully managing to boost restaurant-level profitability, even in the face of negative comparable restaurant sales and persistent, punishing tariff pressures on its imported Japanese ingredients. During the high-stakes corporate earnings call, President and Chief Executive Officer Hajime Uba announced that the enterprise has made significant, sustainable progress toward returning to its historic benchmark of a 20% restaurant-level operating profit margin. This achievement is particularly impressive when you look at the raw cost constraints. Due to ongoing international tariffs, the company's cost of goods sold as a percentage of total sales remained a steep 200 basis points higher than the exact same period last year. However, rigorous internal operating discipline completely offset this heavy macro drag. Total top-line sales for the fiscal third quarter climbed to a strong $85.9 million, representing a solid jump from the $74 million posted in the prior year period. While comparable restaurant sales technically dipped by 0.4%, driven by a 5.1% decline in overall foot traffic, Kura Sushi successfully countered the traffic drop with a 4.7% pricing and product mix contribution, backed by an effective quarterly price increase of 4.5%. When we look under the hood of Kura Sushi's financial engineering, the margins tell a fascinating story for finance enthusiasts. The restaurant-level operating profit margin successfully expanded to 19.1%, up from 18.2% a year earlier. Adjusted earnings before interest, taxes, depreciation, and amortization rose to $6.6 million, compared to $5.4 million previously, pushing the adjusted margin up by 40 basis points to 7.7%. Even though food and beverage costs climbed to 30.2% of sales due to those imported ingredient tariffs, the company managed a 20 basis point sequential improvement from the second quarter through aggressive vendor negotiations. The real margin savior, however, was labor cost optimization. Labor and related costs drastically improved to 30.6% of sales from 33.1% last year. Senior Vice President of Investor Relations and System Development, Benjamin Porton, revealed that these massive labor efficiencies were heavily driven by the company's proprietary smartphone reservation system, which successfully reduced expensive front-of-house headcount requirements and enabled much tighter employee scheduling practices. Ultimately, Kura Sushi reported a microscopic operating loss of $39,000, which is a massive improvement from the operating loss of $162,000 in the prior year quarter. Net income arrived at $423,000, or 3 cents per share, backed by a pristine, debt-free balance sheet holding $66.1 million in pure cash and short-term investments. Looking ahead, despite temporary fire inspection delays that pushed their fiscal year 2026 revenue guidance slightly down to between $331.5 million and $331.5 million, the long-term pipeline looks incredibly robust. The brand is rolling out high-demand intellectual property dining collaborations with massive gaming franchises like Nintendo's Yoshi and Persona, alongside automated robotic dishwashers to completely eliminate back-of-house labor expenses. For growth-oriented finance enthusiasts, Kura Sushi USA is proving that leveraging automated technology is the ultimate antidote to inflationary market pressures.
And that officially wraps up this jam-packed edition of today's finance news. From Elon Musk losing his trillionaire crown due to a massive 26% space stock correction, to Enerpac Tool Group executing a massive $472 million industrial takeover, all the way to Kura Sushi using robotic automation to crush inflation. Today has proven that the United States financial landscape is moving faster than ever before. As finance enthusiasts, staying ahead of these macroeconomic shifts is the absolute key to protecting and growing your capital. Which of these 3 major updates surprised you the most? Are you buying the dip on Elon Musk's companies? Or are you looking toward automated retail and industrial tech? Drop your thoughts in the comments section down below. Do not forget to smash that like button if you found this breakdown valuable, subscribe to the channel, and share this video with your fellow investors. Thank you so much for watching, keep your eyes on the data, and we will see you right back here in the next update.